Hey folks, the Federal Reserve could be close to ending QT. We've been saying that for 2 months now, and they've just slowed their QT and slowed their quantitative tightening, and eventually they're going to move to printing. And we know last cycle when that happened, that's exactly when Ethereum bottomed against Bitcoin, and then altcoins took off. I think we're honestly not that far away from the bottom. Can this bounce we're having right now be trusted? This bounce, right? I think it's just a bounce. I think we're probably not at the bottom level yet. The bottom's not in yet. But you know what? I'm going to give you guys the levels where I think Bitcoin will get to and the levels where it could pull back to and what kind of situation we're in right now. So before we get on to Bitcoin and Ethereum, in today's episode, we're going to talk about why I think the Federal Reserve is going to be bailing out, right, the economy or some banks. The only reason they haven't done this yet, we all know, is because Trump and his tariff threats, which may or may not be that real, is basically causing the Federal Reserve to worry about inflation. They've said so exactly because last time in their speech, the Federal Reserve projected that they think inflation is going to get from 2.4% to 2.7% over the next 12 months. So they're clearly telling you they're worried about inflation. But what is it that I think is going to make the Fed end QT? Well, the first reason I gave you guys for a while now is because that the reverse repos are running dry and therefore the market cannot afford to buy any more bonds. So therefore, the Federal Reserve cannot sell any more bonds. But what's the other reason? But first, just for 30 seconds, let's answer the question of which crypto exchange does Pablo He-Man use? Well, Pablo likes this Bitunix so much, I've made a deal with them, right, for my followers to use this link only, basically for the next limited time only, right, to be winning BMW R1250 series, right, and Rolex and trip to Dubai, all these great prizes just simply by joining and trading. Now, Bitunix is basically a non-KYC exchange, meaning you don't need to show your ID, means you don't need to, the exchange doesn't even know who you are. So, of course, Americans can use this exchange. And that means the IRS can't see you. The tax office can't see you. The FBI, CIA, nobody can see you. That's why I like them. Total privacy. Now, if you are watching this on YouTube, then the link is in the description below. But if you're on any other platform, such as this one, then basically just click onto my profile page and we can see right here is my Stan link. We click on the Stan link and it's the first thing that pops up, Bitunix. Okay, let's get back to it all. Just remember, guys, only on the Pablo He-Man link for a limited time only until April 7th. Okay, here we go. Now, the reason why the Federal Reserve is panicking quietly right now is because of this. See this chart. Here we have 90-day delinquency, right? Which type of loans are defaulting the most? 11% of these loans are going 90%, 90 plus days delinquent now. And that's credit card loans. Credit card debt is shooting up. Student loan, the red line, is falling down. And that's, because Biden canceled a lot of student loans. You can thank him for that. I'm not saying that's a good thing or a bad thing. You can thank Biden for that one. Auto loans, car loans, basically also on the ticking up in terms of, well, it's hitting a high. Wow, that's a 13-year high, 14-year high since 2011. See, 2011. In terms of car loans are getting out of control as well. Credit cards hitting also 11-year high, also getting out of control. So what I'm trying to show you guys is that the Federal Reserve is in a lot of trouble. It wants to cut rates, it wants to end quantitative tightening and start QE, but it cannot because of all the threats of the tariffs. So it can't do that. Now, why are they worried about credit card debt? Because credit cards show the American consumer. An American consumer is basically the linchpin of the U.S. economy. What most people don't appreciate is that an economy like China, for example, is more production driven. So it doesn't depend on the consumer. Not their domestic consumers anyway. They export, so they depend on consumers of other countries. But US is the largest consumption market in the world, so therefore people depend on US consumers, not just US economy, but other economies as well. And here, things get actually more alarming. Have a look at this. So the total amount of credit card balance has just risen to now over $1 trillion. So people have something like $1 trillion altogether, all Americans, on their credit card balance. You can see it's going up. And that's not a good sign when total credit card balance is going up, because why would people need to borrow on credit cards? It means they're probably, in some cases, because they're probably not doing too well. And then we look at this. How do we know they're not doing too well? This is the savings rate of United States, right, since 1960. Since 1960, and look what has happened here, right? Now, what has happened is basically we had savings rate go down, and then we had a spike up to 30% savings rate, again, thanks to both Trump and Biden, because they gave out a lot of stimulus checks, right, during COVID. That was 2020 and 2021, right? The two times when they hit the economy with stimulus checks. And since then, savings rate has plummeted, and now it's down near historical lows again. I mean, this level around here, like 4 to 3%, this is basically the lowest it's been, one of the lowest levels since 1960. I'm just trying to build a picture of where the COVID money, the COVID savings have been spent, and now, can you see this? Or is my head blocking it? You can see this. COVID money has been spent, and now consumers don't have much money anymore, so they're going onto credit card debt. They're borrowing a lot of credit card debt, but because US interest rates are high, what happened to credit card debt? Look at this. Credit card debt is now on average at 21.5%. So that's really painful. 21.5% to repay credit card loans. Because interest rates have shot up. We all know that's just what happens. And even before, it was at on average for the last 6 years, it was around 14%. Now at 21%. So what does all that mean? All that means is basically when it comes to the U.S. Credit card loan default jumps almost as high as the GFC now, right? That's GFC level. That's clearly not normal. That's 2009 wasn't even this bad, right? This is COVID year, 2020. This is 2010. So, and this is showing with all the banks in the US, all the banks. Now, if we look at only the small banks, right? If we look at only the small banks, then what happens is that if we look at the small banks, what happens is they are in an even worse situation. The default rate for small banks on credit card loans is something like this, something like up here, right? It's much higher for the small banks. So overall, when these banks are in this kind of trouble, then the Federal Reserve tend to act, and they tend to basically increase liquidity in the system. So how do banks increase liquidity in the system? Well, how do the Federal Reserve do that? Well, the Federal Reserve basically just ends QT, quantitative tightening, which means they're taking money out of the system, out of the banking system, and they start QE or stealth QE by bailing out these banks which are in trouble right now, that, like I just showed you, by using programs such as BTFP. You can Google that. BTFP, I've explained that a number of times before, bails out the banks with liquidity. And that is why I think the Federal Reserve would have done that yesterday, if it wasn't for the Trump tariffs. Again, I'm not pro-Biden, not pro-Trump, not pro-anybody. Just saying, I don't think the Federal Reserve is going to hold on for much longer. I think we're going to see end of QT in the next few weeks. Okay, so and last time that happened, there was the bottom of ETH versus Bitcoin. So now let's have a look at Bitcoin and Ethereum. Okay, so with Bitcoin and Ethereum, basically last time in my last video I said we're doing a ABC pattern, which basically means when you're doing a pullback, which means that's A leg down, B leg up, and then C leg down, right? To probably like 73K area. I've been saying that for a while now, and we hit 76K, so not quite my target, but close enough. But I do think we have one more leg down because I think the stock market, the Spider ETF, SP 500, Nasdaq all have this A, B, C pattern going on, and so far we're on the bounce. So to me, I think that means the SP 500 and the Nasdaq are on this B leg as well. And when the Nasdaq and SP 500 go onto a C leg, right, then Bitcoin and Ethereum go on C leg down as well. And usually that means, in my opinion, if we get really lucky, could just be a double bottom, like not much lower on stocks and crypto, but chances are it takes out this bottom and goes a bit more lower. So 73K still remains to me a likely target, right? Low 70s. In terms of this bounce, I think big resistance here at 89.7K area, right? This blue trend line, right? Resistance has been held in place once, twice, 3 times now. If it was to be broken, and then the resistance 91.8, and if we can close a couple of days above here, then I believe the bottom is in. Until then, if we get a couple of closes above here, then I believe bottom is in, and if you dollar cost averaged some down here, then well done. Until we get that, then I would think technically we're still heading for a B, C leg down with low 70s, something like 73K as the target. Okay, let's have a look at Ethereum. So ETH, I think, is in a similar sort of situation, and ETH basically is also in a kind of an A, B up, C leg down. In terms of the B leg bounce, I would think the rally is capped something at mid 2100s, like 2150, 2160 area, and then we go down. I'd be very surprised if it can get to this 2300s resistance area. So probably something like this, and then one more leg down. And I still think this 1700 area would hold. Of course, it was a wick down into the 1600s, something like this, right? Wick down into the 1600s, A, B, C, and we bottom. And folks know that I've been bullish longer term during this dip. I've been saying that I think we're still going to get a big local bottom after this ABC move, and I think the market bottoms in the next 2 to 4 weeks. I've explained this many times in my last few videos for the reasons I explained above, and then we have what follows the ABC leg is either a very big bounce or even a new blow off top. So yeah, I've been buying the dip slowly, and if it does play out the ABC leg, I would try to make sure myself personally to try to buy that major, what I think will be a major bottom, local bottom as well. Okay, for all the Aussies watching, Pablo uses SwiftX. The link is in the description below. Thank you guys for tuning in. I'll catch you for next episode.